Now when you think about the account and the different items that we talk about, we all started off with the basic accounting equation. A equals L plus SE, right? Now with this particular account, you'll notice that there is a left side and a right side. So when we start talking about account, we're going to actually come up with a place to record all of the changes within each individual account. That includes all the assets, all of the liabilities, all the stockholders' equity, which also includes the expenses, the revenues, the dividends, and the individual retained earnings and common stock. So what we're going to do is we're going to keep track of all that. So when you think of the word account, we're talking about increases and decreases, changes that are occurring to each individual item. Now with that said, in accounting, to try to organize all of this, in our simplest form, we use something called the T account, and it has a left side and it has a right side. Now the official terminology that we use for the left side, we call it debit, D-E-B-I-T, debit, and we call the right side credit. The abbreviations we use is DR and CR, and it has something to do with the Latin derivatives of the words. Okay, so the left side is debit, the right side is credit. Now for those of you that have heard these two terms before, forget everything you know about debits and credits. Forget about your debit cards, forget about your credit cards, forget about when you talk to your bill collectors and they talk about where debit your account or what credit your account, forget all of that. The official definition, if I ask you on a test, what does debit mean? Your answer should be the left side of the account. That's all it is. Debit means left. Okay? Now, when you're looking at me throughout the course of the semester, keep in mind that I know this is my right hand, so I'm like doing this opposite like the aerobics class so that you guys won't be confused. But for some of you that know how to do the mirror image, please keep in mind that this is the left side, even though this is my right hand. Okay? So left side. Now if I ask you what credit means, what would you tell me? It means the right side of the account. So that's one of your test questions that's going to be on your final, so you might want to remember that for December. Okay, so assets equals liabilities plus stockholders' equity. You'll notice that the A is on the left side, the L and the SE are on the right side. And it's going to help you in a few moments. Now something else that you're going to need to know is what does normal balance mean? Normal balance means the side of the account that increases, that goes up, that causes the balance to get higher. So the normal balance of an account is the side of the account that increases. So that means that every account will have one normal balance. It'll either be the left side, which is the debit, or it will be the right side, which is the credit. Some accounts will increase on the debit side, and some accounts will increase on the credit side. Okay. So, if you want to increase an account, you will put it on the same side as the normal balance. I'll say that again. If you want to increase an account's balance, you will put the dollar amount on the same side of the normal balance. So, I have a question for you. If you want to decrease an account, what side would you put it on?
Depending on what type of account it is.
It depends on what type of account it is. It depends on the normal balance of the account. So whatever the normal balance is, you would put it on the opposite side of the normal balance. So if you want to decrease it, it's the opposite side of the normal balance. If you want to increase it, you put it on the same side as the normal balance.
You want to decrease it on the
Opposite side. Yes, opposite side. Any questions on that?
So if it increases on credit, it increases on debit, right?
Yes, it does opposite. Yes. Okay. Any questions on that? So every account is going to have a debit side, credit side, and it's going to also have a title, which which is the unique name, and this could be the cash account, it could be accounts payable, it could be accounts receivable, it can be service revenue, it could be retained earnings, it can be common stock, whatever the specific account, that's the title you use for that particular account. And we call this a T account because it looks like a capital T. Any questions on that? Okay. So, using this system that we record our transactions, we remember when we were talking about everything must what? Stay in balance. Our left side has to equal our right side. Now, the question might be, well, how am I supposed to know what the normal balance is of each one of these accounts? Do you expect me to memorize every single normal balance for every account? No, not really. That might be too much because some companies have like 1,000 accounts, and I would hate for you to have to memorize. However, I can teach you some rules that will allow you to remember. A represents what? Assets. So as long as you know what an asset is, if an account happens to be an asset, you can assume that its normal balance is debit. So for all normal assets, the normal balance for asset accounts is going to be on the left side, the debit side. So asset accounts, just regular asset accounts, have normal balance of what? Debit. So, what's an asset? A resource owned or used by the business to provide some future economic benefit, right? So that asset is something that is held by the corporation. So someone just told me cash is an example. Accounts receivables example. Equipment is an example. What else? Supplies, building, all of those things are what assets. So if I asked you, what is the normal balance of accounts receivables? What would you tell me?
Left side. Debit side.
Left side, debit side. So the normal balance for accounts receivable is debit. What about cash? Debit. So if you want to increase your cash account, what side are you going to put it on? Left or right? You're going to put it on the left side, the debit side, because the normal balance is debit. So that means that the credit side, if you put it on the credit side, what would happen to the account balance?
Decrease.
It would decrease. So if you want to make your cash go down, you would put it on the credit side, which is the right side.
Does it matter, are they interchangeable when you say credit or right? I mean, are they, do you have to?
They're interchangeable in this class, but you probably want to get in the habit of saying credit versus debit. But I don't want you to think of debit and credit as negative or positive. I want you to think of debit or credit as left and right. Yeah, because you're going to see that it's going to switch when we look at some other accounts. Okay, then you have your liabilities. Okay, now liabilities, on the other hand, the normal balance
Gives credit.
is on the credit side. So the normal balance is on the credit side. So that means if you want to increase a liability, you have to put it on the credit side as opposed to the debit. Now the debit side will allow you to do what to a liability?
Decreases.
Decreases. Everyone see that?
Why does that seem so backwards?
And the reason, you probably, if some of you have ever looked at your bank statement, and you look at your cash, and they tell you, oh, you have a credit to your account, and it's a deposit. It's causing your account to increase. Well, that's the opposite of what we're talking about here. Now, keep in mind, I told you, I guess last week, about a coin having two sides. It depends on what side of the transaction that you're on in terms of how it looks. When the bank is preparing a bank statement, they're not really doing it for your benefit. They're doing it for their benefit. They're just keeping track of this information. So when you deposit money in a bank account, the bank is liable to you. They owe you money. So on their records, it's debt. So every time you make a deposit into the bank, Bank of America, okay, you deposit $100, guess what? Now Bank of America owes you $100 because that's been put in your account. But then, if you go and go to Subway, buy lunch, and you spend $5 from that account, and you use your debit card, it decreases that bank account. Bank of America doesn't owe you the $5. Now they only owe you $95. So with that debit charge, they're debiting your account. They're decreasing their liability, their obligation. So depending upon how you look at it. Yes. So if you were preparing those same transactions on your records, it would be the flip side, the opposite. So that's why it's kind of different. And the same thing is when you call about your bills. Well, it's a liability to you, but to them it's a collection. It's a receivable. So it's on the flip side. So it depends on how you're looking at it. So whenever you do journal entries, which we'll talk about in a moment, or recording of information, you got to figure out, okay, which side of the transaction am I on? Am I on the buyer side or the seller side? Is this a debt to me or is this an asset to me? So that's really important. A good question. Okay, then stockholders' equity. Now we talked about that. Stockholders' equity is comprised of two components: the paid-in capital portion and the piggy bank that I refer to as retained earnings. Okay? So, with that, we have common stock, we have retained earnings, we have revenues, we have expenses, and we have dividends. Now you'll notice that I put the expenses and the dividends underneath the assets. I did that intentionally. And the reason why I'm doing that is because I want to make sure I have it on the left side. And you're going to see why I put it on the left side as opposed to the right. Now, common stock, retained earnings, revenues, yeah, that's a part of the stockholders' equity. Now, if we remember from Chapter 1, common stock, retained earnings, and revenues all did what to our stockholders' equity? It increased it. It made it what? It made it go up, right? So when it went up, it caused my right side to go up. Now on the flip side, expenses and dividends, what did it do
Make it go down.
to my stockholders' equity? They what? Decreased it. So there was like an inverse relationship. So because these two have negatives or cause our stockholders' equity to decrease, we actually put it on the opposite side because of that inverse relationship. So we have assets, expenses, dividends on the left side, liabilities, common stock, retained earnings, and revenues on the right. So what that means is all of the liability accounts, all the common stock accounts, retained earnings accounts, revenues accounts are going to have normal balance of credit. Credit. That'll be our normal balance. That'll be the side that increases. Normal balance. Side that increases. Credit. Normal balance. Side that increases. On the expenses and the dividends, normal balance will be on the debit side. They will both increase on the debit side. So, for liabilities, common stock, retained earnings, and revenues, they will decrease on the debit side. Decrease on the debit side. And expenses, they will decrease, like the assets, on the credit. Does that make sense? Any questions on that? So what does normal balance mean?
Side of the account that increases.
The side of the account that increases. If you want to increase it, you put it on the same side as the normal balance. If you want to decrease it, you put it on the opposite side.
On the dividends, you're not putting dividends in our assets, but it's just.
You're not putting it as an asset. I was just trying to identify what the normal balance are for
Okay.
the accounts.
Can you give an example using an expense or a dividend?
Okay. So for dividends, that would be the actual account name. Now expenses would be utilities expense, supplies expense, depreciation expense, rent expense, pretty much anything with expense at the end of its name. Revenues would be service revenues, fees earned, earned revenue, rent revenue, commissions revenue or commissions collected. Those would be examples of what? Revenue accounts. Examples of liabilities would be accounts payable, notes payable, mortgage payable, unearned revenue would also be an example of liability. Unearned revenue would be an example of liability because you are in debt to your customer for amounts they paid you for in advance. Those would be examples. Okay? Now, if you are still not a visual learner and all these colors is not really working with you, but you're better at reading and writing, what I do is I have an acronym. Let's see. And it's beyond the space. I have after eating dinner let's call Red Robin. Okay? So what that means is, if you drew a T account, and you put down, after eating dinner, let's call Red Robin. That would be your debit side for normal balances. And this would be your credit side for normal balances. Oh, assets, expenses, dividends, normal balance is
Debit.
debit. And the LCRR, liabilities, common stock, retained earnings, revenues, normal balance would be
Credit.
credit. Everybody got it?
Mhm.
Well, that's half the battle. Okay, any questions on that? Normal balance means? Debit means? I only hear some of you.
Left side.
Left side. And what does credit mean?
Right.
Right.